What's up, guys? It's October 3rd, 2025. We're going to do a 10-minute breakdown of the E-mini where we talk about trap traders, probabilities, and market cycle. I haven't been taking any trades, but if you want to see more about how I trade, please consider joining the membership section and checking out my live trades where I go over breakdowns and how traders are getting trapped. Trap traders move the markets, and again, I like to make these 10 minutes or less, fast, quick, straight to the point. So, E-mini, we had a clear 3 legs up that puts us into a trading range, and then the market sold off. Really nice for the bears because they haven't had bars like this in a while. Then we have the weekly chart on the left and the daily chart on the right. Weekly chart's getting follow through. We have 3 bars here. Bears get trapped down here. They short more higher, and they try and get out at a discount. When I say discount, I mean pullback. When the market's pulling back, that's an opportunity for bears to get out with less of a loss. So they buy back shorts, and that causes the rally. At the same time, where bulls are buying the pullback to add to their winning position. Here's a better look at it on the daily chart. Bears get trapped down here. The market rallies. This bar gets bad follow through, so they start to short. And then look at the tail of this bar. It's actually a really nice reversal bar, but it is happening around highs. So bears short down here. Market rallies. They buy back shorts. Same place where bears are buying back shorts. Bulls are going to get long, and the bulls are front run. So some bulls bought down here, some bulls bought up here. And once they see 3-4 bars in a row, they see follow through. They want to add to their winning position, and they do that at a pullback. This is where the probability shift for a small moment in time because bulls are buying back. Because bears are buying back shorts the same place bulls are buying. So 2 types of traders are doing one thing, and we are the third set of traders looking for that second leg. So 3 types of traders doing one thing, all have different agendas, all looking to buy around the same place, and that's where the probabilities shift into our favor. So that's how I trade. That's how I talk about these breakdowns, and the market cycle also helps me determine where those trap traders are at. If it's the beginning of a market cycle, a fresh breakout, those trap traders are going to be around support and resistance, and the limit order traders. If it's the channel phase, which is after the after the breakout, I like to think breakout, first opposite bar starts the channel phase, and the market starts the channel. Once we get into that third, fourth leg, I'm thinking trading range. Another one is if I see a rally, if I see an opposite channel against the main channel. So here's a bull channel, and here's a bear channel. We're above the higher time frame regime. EMA, which is a bull regime. So we have a bear channel against a bull channel. That tells me we're in a trading range. Gap up, bar 1, nice bull bar, good follow through for the gap up, and then follow through bar 2. So this is great. The gap up's 1 bar, there's 3 bars here, but we can also look at the gap up as included. We can look at the gap up as a bar included with bar 1. Follow through bar 2, small pullback here. We can see the tail. We have a deeper pullback on bar 3 and first opposite bar, so now the market's channeling. In trading ranges, second leg traps are common, and at this point in time, we don't actually know if we're going to have any legs up. So it could be a trading range because we're at the high of yesterday. So leg 1, pullback leg 2, bad follow through on bar 5. And we also have an inside bar on bar 4. Inside bar is a breakout mode. I still have this thing on, but I haven't done a study yet. Breakout mode means it can go either way. The market gets a breakout to the upside and then reverses to downside bar 6. Bar 6, bear bar closing on its low. Bar 7 is follow through, but it has a tail. So bulls are willing to buy the EMA. Bulls are buying below 1. Bears want to get at least the gap fill, but then they get trapped. Bar 8. So bears that short here have bad follow through. They're trapped. They're going to buy back shorts. 1, 2, 3, 4, 5, 6, 7, 8. 8 bull bars in a row. Showing off to get a second leg. So if you want to reset the breakout or reset the market cycle, here's your breakout. Bar 16 initiates the channel phase, and there's a quick scalp. Bar 17. So you fade bar 16. Market sells off. It doesn't really sell off, actually. It just goes more sideways, and that's good for the bulls, bad for the bears. Bears want to see this type of price action right away. Instead, it goes sideways into the EMA, 2 to 3 legs down. Leg 1, pull back leg 2, pull back leg 3. Could say leg 1, pull back leg 2, trend line rate, pull back leg 3. The leg 3 is on the tail of 27. 27 sells off and reverses. So bears that were trying to short as the bar was moving are now trapped, and then it rallies. Leg 1, pull back leg 2, pull back leg 3. Bears know this is leg 3, and instead of exiting out, they're scaling in. So bears can be shorting here, here, and here, and the market starts to go sideways. I didn't trade today, but if I did trade, this is a leg that I would look for a second leg, a quick scalp, and I might get stopped out because I don't have an opportunity to get out at break even. So I think it was hard to trade the bull side today because look, let's say bears try and short the small tick on bar 1 and the market rallies. Bears actually make money on bar 7, so that's a tip. That's a sign that we're not necessarily in the strongest trend, but you could get filled right at the 50% mark and then catch 1 to 1.5 R. And we wouldn't get filled if you're trading 50% pullbacks. Would we get filled? Actually, let me see. Yeah, so we wouldn't get filled on this rally up. See, because this middle line's our entry. So limit order traders aren't, this is like a buy the close rally, and limit order traders really can't get in. Then we have a smaller second leg. So if we were to go like this again, that's what I mean. See, I'd get filled on 41 and then I'd have to exit while this bar is moving 43. So that might be a full R hit. Nonetheless, I was looking at the downside, and the downside offered more trades. Look at the tails on bars 38 through 42, 40 through 42. More than, it's 3-4 bear bars in a row. So we know bulls are getting trapped because there's tails above them. Put the order there, put our second entry there. Bears see this, bulls see this, and try and fade it to get out of break even, and they get their break even attempt on 45. So we have a new breakout, new market cycle. Market cycles can be within the bars or within the time frame, bigger, smaller. So here's the market cycle breaking out. Just breaking out, market cycle, 3 legs, and now we're in a training range. But in the context of these bars, 43 is the start of a new market cycle. But we still are in an overall trading range. A couple of components going on here. Sells off, bulls buy back shorts, 50% pullback. That's where bulls average prices, they get out. So bears short here. They see the pullback, they add to the position. Second leg traders are shorting of 45. And bulls are selling out. So 3 types of traders doing one thing. And then you can see 1.5, 1R, 1.5R, 2, and maybe even 2.5R was met. Let's say you don't catch the first trade, and that's okay, because look, 46 through 49 also offer an entry. Bulls see 45 thinking it's going to reverse and make a new high of the day. So some bulls buy this instead of getting out. The market sells off. They start to fade because the probabilities for a pullback go up after 3 bars in a row. 46, 47, 48. 3 bars in a row, shot off to get a second leg, but first we have to pull back. Bulls buy here, they buy more down here. They sell out of 49. Look how 49 hit the 50% mark and then sold off because bulls are desperate to get out. Bulls are selling, and we get a climactic move down 50 through 53. Now this does look like a shot to get a second leg, but the issue is we're in the third leg, and the probabilities go down for continuation when we're in that third leg. And you can see how it was a deep pullback. If I saw this rally, I would be more inclined to get long because we're in the third leg, and 53 is climactic, and we're above support, or we're on support, I guess. 54, big bull bar, pulls back, 53, shot, so 54 alone, shot to get a second leg, and it does, 50% pullback. Some bears are shorting down here, thinking it's going to be a start to a new breakout. But remember, we're in a training range because of the open, big up, big down, bears are making money. So we're at the low of the training range, the magnet could be around the opening price. 54 rallies, pulls back, bear short here, they short up here, they buy back shorts here, and you can see 1.5 to 2 bar was met very quickly too. 57, 58, 59, and 60. This is a risky trade. I wouldn't do it unless you've back tested it. And then we kind of go sideways into a tight trading range. This is shot to get a second leg, and this is shot to get a second leg. And earlier I mentioned how that's a sign for me that we're in a training range. Just like up here we're in a training range, now we're in a training range down here. So leg 1, pull back, channel phase, leg 2, pull back. Leg 3 puts us into a trading range. So overall, we're in a trading range. We have a small market cycle going on here. We have a small market cycle going on here. And these two things overbuild the entire structure of the day, which is a trading range day. And we read that from the first 6 bars of the day. All right, guys, this is about 9 minutes. I hope you enjoyed this. This is the way I'm going to be doing the breakdowns, a little bit faster pace. I like keeping them under 10 minutes. I hope you guys had a good one. Hope you guys have a safe weekend. I'll talk to you on Monday. Thank you for your time, everyone. Bye.